Sometimes there are moments to make money in the markets. Other times there are moments not to lose money in the markets. Can you figure out which time is this time? Hi, my name is Kareem Zakir and welcome to my quarterly capsule. Before I answer that question, I'd like to do a quick market recap as to what happened in the month of September and so far in the month of October. You'll notice that your statements have dropped in the month of September. That's because the markets dropped by approximately 5%, and it pretty much brought the portfolio statements back to where they were on June 30th of this year. The positive side of this story is that at least for the month of October so far, we've seen a market rebound somewhat. So in order to answer this question, first thing we must look at is where are interest rates headed? If interest rates are going to be rising in the near future, odds are the markets might drop as a consequence. Whereas if interest rates stay where they are or fall, then you'll see the markets rising forward. Personally, I feel that long-term interest rates, meaning the 10 and 30-year interest rates, are probably going to go lower, while the short-term rates, meaning the 1, 2, 3-year rates, are probably going to rise. The bond market pretty much is reflecting that there's going to be lower economic growth going forward, and thus what happens is the yield curve becomes inverted. Now, history has shown us that when the yield curves invert, then we're possibly looking at facing a recession. Now, if interest rates do not rise, if they stay where they are or they're going to come down, that means the economy is going to continue moving forward, probably at a slower speed, but at least it's going to be positive GDP growth going ahead. As you could see on this graph, currently what we're seeing is a normal yield curve where the short-term interest rates are lower than the long-term interest rates. This is where the banks and life insurance companies make money, because what they do is they pay your deposits a very small sum of interest, and they lend out longer term to people who need money at a spread. That spread is the profit. If we fall into a scenario where the yield curve begins to invert, for instance, a term deposit for 1 year can pay you 2%, whereas the 5-year pays you only 1%. And this is not good for certain sectors of the economy, such as banks and life insurance companies. It's also not very good for cyclicals like the energy sector. However, it's going to be good for other sectors, such as the utilities sector or the healthcare sector. Personally, I believe we're going to be entering this phase of an inverted yield curve where short-term rates may be higher than the long-term rates. And so the portfolios need to be invested appropriately in consequence of this scenario unfolding down the road. Incidentally, I just wanted to show you also that it does exist where we do have on occasion flat yield curves, meaning that the short-term rates pay the exact same amount as long-term rates. The ideal scenario is to be in a normal yield curve where short-term rates are lower than the long-term rates. That means that the economy is moving forward, it's moving up. The gross domestic product will be moving positively. So just be aware that I'm being very vigilant, defensive, and own quality businesses and quality government bonds in addition to precious metals. A good diversified portfolio will not do as well as the stock market when it's going up, but it'll do very well against the stock market that's going down. I'd like to touch base a little bit on Facebook. So there's been a lot of controversy with Facebook lately, being that the company is not very ethical. However, Facebook, who has 3 billion members on its platform, you'll notice that the advertisers don't leave Facebook, because when they leave Facebook, their advertisements are not as effective. They actually lose money. So the lion's share of advertising on the internet goes to Facebook and Google. And so we do need to have exposure to this sector because there's tremendous growth going forward. Now we have to understand what Facebook is. Facebook is not just the app that you have in your phone that has the F logo. Facebook is a combination of different companies combined. It has the regular Facebook, of course. It has the Instagram. It also owns WhatsApp, Messenger, Shops for a lot of small businesses during the pandemic. Thanks to Facebook, a lot of merchants survived. Some of them even thrived because they can open up a shop on Facebook. It's a virtual shop. And so this definitely has a lot less cost to a business owner than opening up a bricks and mortar type of business outside. In addition to all that, there's DM, which is Facebook is working on a stable coin. And lastly, they're working on something called the Metaverse. What's the Metaverse? Well, the Metaverse is basically a reality lab. And it's going to offer a virtual experience on the internet. For instance, instead of watching the internet, you'll feel like you're in the internet. You'll be able to look at clothes. You'll be able to try jackets on virtually on the internet. This is coming down the road, and Facebook is actually the furthest ahead in this domain. So the Metaverse could actually going to revolutionize the internet. It's still far off. Nevertheless, I always look for opportunities that are going to come in the next 3 to 5 years, and Facebook is definitely a company that is looking to be at the cutting edge of this technology. There's controversy, of course, behind Facebook, as we said earlier, and maybe Facebook will be forced to break up. And you know what? Let it break up, because the parts are worth more than the sum of the parts. So for those who gave me the privilege to manage their portfolios since the beginning, they'll note that I purchased Facebook stock back in 2013 at $48 a share US. And today, that stock is at $320. So when you hold a quality business in a sector that's growing, you're bound to do well down the road. In conclusion, I just want to remind you that if you'd like to have a meeting with me, we can do it virtually or now at the office. We are slowly getting back to our offices. I'll be more than happy to sit down and talk with you, review your portfolio, and discuss whatever's on your mind. On that note, thank you very much for listening, and I'm looking forward to seeing you in the next quarter. Bye.